Chris, why don't you take us away, my friend?
Okay, sounds great. Well, nice to be with everybody again. We're going to talk on state of the market, what's going on out there. You're going to see a slightly different feel this time, in part because we are celebrating the 250th anniversary of the founding of the United States, and thought it was a good moment for us to take a brief detour. But we will try to tie that into everything that's going on in the world today and what's happening in the position of the United States, the economy, the markets, and where we go. Markets have, as everyone has seen, continued to do relatively well from the sell-off that occurred in March. We've seen the market come back a long way. Been a bit choppier and bumpier here over the summer months, but that has been pretty typical, especially as we're in this lead up to the midterm elections. So there's a lot going on. What we want to do is first start by saying, here's all your disclosures. Please feel free to read those at your leisure. But happy birthday, America. So we are at the 250th anniversary of America's founding. And while that dog is not one that I can claim, it was certainly a cute photo and very hard to pass up. We hope everybody had an opportunity to step back, take a little bit of time away. Hilgard, I know you mentioned that you were in North Carolina attempting to get away, although maybe it didn't work out quite as scheduled. But we're at this juncture, which is a very unique moment in time, and wanted to just reflect back on all the things that have happened and where we potentially go from here. So we're going to start all the way back on day one, and then we'll walk through every year. No, I'm just kidding. But we will start from the early days, because one of the things that's really important here is to understand all of the systems that were put in place very early on and how they led to so much of the success that we're seeing economically for the United States. Now, the slide you're seeing here is a little hard to see. I realize there's a bit more text on it than I may have anticipated. But what I wanted to get across is that there's one person and there's one central figure that started the country and set us off on a path of not necessarily destiny, but on a path of success that I think is really important, and it's a story worth sharing. So the individual we want to talk about is someone that has gained a lot of popularity over the last decade, in part because of a very prominent play that is starring on Broadway and elsewhere. It's moved around the country, and that individual is Alexander Hamilton. The role that Hamilton played, which some people are familiar with, but I think many people don't yet really understand unless you're reading the biography, and his biography is thousands of pages long, so it's a little hard to get through. But if you have time, I do encourage you to read that book. What Hamilton did was create unification in the financial market. So what we're going to talk about is really the investment developments that have happened and the really important financial market development happenings, not so much the political elements or the social elements. But what Hamilton was able to put together was a central mechanism for all of the debt in the country. So when you were looking across the entire landscape of the United States at that time in the early 1780s up until the end of the 1780s, there was debt all over the place, meaning that people had been borrowing money, and it was borrowed under a structure of IOUs. Now, if anyone remember IOUs from our college days, anytime I told somebody I owe you, I didn't really expect that money was ever going to be paid back. And that was exactly the experience that was happening in the United States at that time. The U.S. had about $40 million of public debt across all of the continental states. And that accounted for roughly 40 to 50% of total economic growth. Now, today we have debt to GDP that's quite a bit higher than that, but we're a mature country with a lot of mature businesses. We have a bigger population. So the idea that this startup country had 40% to 50% debt to GDP at the time was a little hard for everyone to figure out, how is this going to work? How is the United States not going to go bankrupt? Well, Hamilton was able to figure that out. And what he did was create a unified system of debt that brought together all of the IOUs. And at that point in time, it was really the founding of the U.S. Treasury market as we know it and where it's come today. So the U.S. Treasury market is central to so many of the things that have led to our success as a country. Perhaps most critical around those is the role of the US dollar as the reserve currency of the world. So if you fast forward throughout the 1800s, and we'll talk about some of the economic events of that time, but throughout the 1800s, there was no Federal Reserve. So Hamilton started the idea of the U.S. Treasury market, brought forth what was called the first bank of the United States. And that first bank laid the groundwork for what eventually became the Federal Reserve. But it was well over 100 years before the Federal Reserve came into existence. So why do we share this? Well, because the U.S. Treasury market is one of the de facto go-to places for investors to deposit money. It became that risk-free rate that many of us are familiar with. So the idea that it has never been defaulted on, that there is stability of Treasury securities in terms of their performance and the likelihood that you're going to get paid back. We've never had issues there. And then you see the system of the Federal Reserve that was implemented between 1907 and 1913. Well, what you have is down at the bottom, something that's really important and really critical to this day. The US dollar is the reserve currency of the world. So as you're looking at the table at the bottom, we're showing you cross-border lending, international debt securities, perhaps most importantly, though, foreign exchange transaction volume. So as businesses are conducting their affairs around the globe, what currency are they utilizing to settle when they're making purchases or making sales or there's transactions that are happening? It's the US dollar in 89% of those transactions. So there's so many questions that often get asked of us. Is the US dollar going to be in decline? Are we going to see that status goes away? Where we are today, there is absolutely no evidence that that's happening. The one area you could point to, which a lot of people bring to our attention, is that official FX reserves number down there, from the second to the bottom, which has actually trickled lower. So when you're looking at all the other central banks around the world, the currency that represents about 57% of those assets now is the US dollar, and that has gone down over time. People say, well, that must naturally mean that central banks are moving away from it. But the answer there is that they're not moving away in totality into another currency. They're simply diversifying out and dispersing out into areas like gold, which we have in portfolios. They're going into other currencies like the Swedish krona. They're going into Swiss francs. There isn't a single currency that has taken over the role of the US dollar. So the systems of the Federal Reserve, of the US Treasury that Alexander Hamilton put in place really brought us along over the last 250 years, and they've been really, really integral to so many of the things that have happened. Now, the other point that I want to make, though, is that there's been a natural evolution in the U.S., which you don't necessarily see in other countries. And that evolution is really this arc of how innovation happens, how investment happens, and what ultimately comes from the boom and bust cycles that many of us have experienced over our time. So what we see is that when you're looking at the evolutional arc for the United States, there's investment breakthroughs. There's breakthroughs in terms of ideas from the academic system, from businesses and entrepreneurs. That leads to a build out of infrastructure. But what happens in step three, and the thing that I think brings a lot of concern to many of us at points in time, is the speculative nature that begins to happen. That speculative nature has been going on for at least 200 years now. So I'm here in the state of New York, and one of the speculations that happened in the early 1800s was the canal boom. Canals were something that people thought they could just build into perpetuity. Banks were investing in them. Individuals invested in the canal infrastructure and build out. Well, lo and behold, you had a massive speculative boom that was followed by a bust. And that bust at that point in time led many people to think that we were going to go into a Great Depression, that the financial system was going to collapse on itself. What we actually found out was that didn't happen. And what actually occurred was that the infrastructure from all of the canals that were built throughout New York and out into the Midwest led to migration of individuals. It led to the transportations of goods and services. It made it easier to get things around the country. And that infrastructure has been used for now almost 200 years. So the infrastructure led to productivity gains that came in the decades ahead. So what we like to remind people is that as you're thinking about the evolutional arcs of the United States, we've been very good about taking a quote unquote goldfish mentality. And what I mean by that is that as scientists have studied goldfish over time, they seem to have no memory. They just sort of forget about things relatively quickly. And the US has done a remarkable job of finding those innovations, those breakthroughs, going through the speculative cycle, but then also living through the bust and moving on to the next breakthrough. We don't simply let the past issues and challenges cause us to shut down and not move on to the next cycle. We've been really, really good about moving to the next one. And we see that even within the last 30 years. You had the internet era of the late 1990s. You had the financial crisis throughout the 2008 environment. But we still see in the last 15 years, the build out of AI and semiconductors and chip production and the healthcare industry. There have been so many things that have been supported by the U.S. economy and the developments that we've made that after an environment like 2008, you would say, do we want to continue doing this? That goldfish mentality continues to show up. Now, I will point out just a couple of different technological revolutions that have you see the textile factories figured out how to power the water, which a lot of times people forget about. But all of that infrastructure over the course of the first 100 to 150 years has continued to support us economically for decades and decades after. The electricity, steel, oil developments, the factories, and the beginning of mass production in the early 1900s. Well, then you jump forward to the post-World War II era. Where we are today, 2026. There's a lot of questions that pop up around artificial intelligence and the speculative nature of it. What's going to happen? What we would say is that you don't have to be so fearful of bust cycles because they do bring us productivity growth in the future. And we see similar things happening within our own business as we've utilized AI and large language models to increase productivity, to select better investments, to help us analyze and assess economic data. We are seeing the power of AI, but I will say there's certainly a lot of speculation out there. Hilgard, I don't know how many questions you get around AI on a daily basis, but I assume there's some skepticism.
Yeah. You're breaking up a little bit, so I think that smoke cover is interrupting a little bit. But can you hear us good?
Yeah, I can hear you. Sorry about that.
No problem.
What's going on? It must be the smoke.
You know what I do like is I like your previous slide, because I think in your previous slide on the bottom of that it says it very, very well. You know, it's like what you had there is the hype cycle often destroys weak balance sheets, but it rarely destroys a genuine platform technology. And I think you're absolutely right. The biggest question is this market artificially, chased up, driven up as a result of the technology giants investing in each other's programs, if you would, to get the infrastructure for AI going. And then obviously are we over investing into this? Will it ever translate into profits, right? So that's the big question.
Yeah, that's going to be the biggest question. And at least what we're seeing is that the productivity gains are starting to show up. So that's a positive outcome in development. You can look at profit margins for a lot of different companies throughout the S&P 500 and even below. And we're seeing that the productivity is there, the profit gains are there. There will remain questions, as there always do, but at least for right now, I think we're okay. I do want to talk on the investment side, though. What are the things that have happened in these last 250 years that perhaps we forget about at points in time? I'll not walk through every single one of these, but I encourage people to take them away to the extent you're ever interested in thinking a bit more about this. But the foundational elements of what Hamilton put in place really instrumental to the last 250 years of success. You also had things like organized stock exchanges, right? As much as we take for granted the idea that the New York Stock Exchange exists on Wall Street, that wasn't the case 250 years ago. But that led to regulations and better access to investments for individuals and households through mutual funds and pooled investing. You had the Investment Company Act, which provided investor protections because fraud was relatively rampant in investment circles in the 1800s and the early 1900s. It's part of what led us towards the Great Depression and then all of the protections that were put in place after that. But perhaps most importantly, are for all of us on the call today, are sections 3 and 4, which was retirement system innovation and then also and cost reduction that's happened over time. When you go back to the initial founding of the stock exchanges and when brokers were transacting, there was a set price, there was a set commission price, and there was no negotiating around that. It wasn't until 2019 that Charles Schwab went to zero cost trading. And we kind of take for granted that we don't have to pay fees to transact anymore. It used to be in the 70s and the 80s, you would pay $49, $79 every single time you wanted to make a trade or a transaction. That's now gone away. So the idea that we've had lower costs, lower fees has really been supportive of better investment outcomes for all of the individuals that are our clients, the people that we work with. But it's also about that accessibility of auto enrollment in things like retirement plans and 401k plans, the rollout of IRAs, both traditional and Roth, and what that can do and how impactful it can be for financial planning as we think about the decades ahead, about transitioning wealth to next generations and how we're supporting the families and individuals we work with. I would also say the final piece here is that idea of smarter portfolio construction. Hilgard, we work with a lot of individuals together where direct indexing is being implemented to try and reduce tax liabilities. And that's very, very powerful. There's a lot of work on the horizon, not only for direct indexing, but 351 solutions, 1031 solutions, opportunity zones. We always want to make sure that the investment merits support the tax benefit. And that's what we always consider first and foremost. But, you just look across the range of things that have happened in the investment realm and sphere. It's pretty powerful when you put it all together. But I think at times we might take for granted how beneficial it is.
I have to remember that I've got to remember that I nerd out about it a little bit. And so I get a little excited about these evolutions and these changes as it presents new solutions for clients.
Yep. And moments like this give us the opportunity to reflect back and see where we're at. I would also say that if you compare the U.S. to other countries, not that we necessarily need to compare ourselves to anybody, what it's resulted in is that we've had a single continuous constitutional system since 1776. When you look at France, there's been 5 separate republics in that time. Germany's had 5 forms of government, but there's actually been many, many different forms at the regional level. And the same thing has happened in China, where you had 3 primary forms of government, but 12 to 20 different regional governments throughout the country in China. That stability is pretty impressive. There's data on how many countries have either failed or gone away since America was founded. And the number is in the hundreds. You have to remember there's only 200 countries in the world. And the idea that 100 different nation states have failed throughout time tells us that, we've been pretty fortunate. Why is that happening? Well, as we say down at the bottom, it's because of Alexander Hamilton. It's the Treasury Department that was put in place. It was the rule of law, the protection of property rights that we are all the beneficiaries of. And what that has resulted in is that the U.S. capital markets are the deepest and the most trusted in the world. The U.S. market, in terms of overall market cap, is measured north of $100 trillion when you put together all of the bonds and all of the equity securities that are issued here. And when you're thinking about the household net worth in this country, so how much collective wealth do the individuals have, it's over $170 trillion now. So when you're thinking about the state of the U.S. economy, that just goes to show you that there's a very strong balance sheet here at the individual level, at the corporate level, and that's really fostering and supporting the innovation, the entrepreneurial nature, and the continued growth of our country. So that brings us to today and what's going on. And so we'll just talk through a couple different developments that have happened in the markets and then where we go from here. So in terms of the markets, when you're looking back at the second quarter and then also year to date, there was a very strong rebound in global risk assets. So meaning all equity markets around the world. You can see that from the S&P 500, Russell 2500, which is small and mid-cap stocks, international stocks, and then emerging markets. What didn't do quite as well was on the fixed income side there, where we've had more volatility around interest rates because of higher inflation. As everybody's seen, prices of oil are higher, and that's put pressure on fixed income markets. When you're looking at S&P performance year to date, though, we essentially achieved a full calendar year's worth of return in the first half of this year. So on average, the S&P is up between 9 and 10%. And you can see here at the midpoint of the year, we're sitting right there at 10%, which is traditionally what we see in the course of a full year. What's led us here? Well, it really comes down to corporate profits. What you're seeing here is the long-term trend line of corporate profitability in the U.S. and how corporate after-tax profits have grown over time. I'll point you to a couple of different things. So if you look on the right-hand side and see where that orange line is today, or at least I believe it's orange, and where it attaches to the dotted lines, you'll see that we're just right along the trend that has been in place for a long period now. Go back to the 1990s and the late 1990s, but then also the mid-2000s, and you'll notice that corporate profits were actually running quite a bit above the long-term trend line. Why was that? Well, it's because we had a couple of bubbles that were happening, and it wasn't just a bubble in price, it was a bubble in earnings, meaning that earnings were growing because there was a circular nature to how businesses were engaging and working with one another. And that happened in both of those periods. What I think is important to understand, though, we're right back at trend. We're not seeing that profits are growing in the way that prior bubbles would have demonstrated. Speaking of profits, though, the first quarter of 2026 was the strongest profit growth that we've seen in the last 5 years, going back to right after that COVID reopening period in the fourth quarter of 2021. So it might be hard to believe, but corporate profits grew by 27% last quarter, which is really impressive. And if you look at each of those blue bars in the last 6 quarters, we've experienced double-digit earnings growth over that time. Which we haven't seen that many consecutive quarters of double-digit earnings growth this century. So you have to go back quite a ways to have seen that happen.
You know, Chris, I remember. Sorry, Chris. I remember last quarter's state of the market, right? End of quarter one. I mean, we were in the middle of the Iran crisis, and there was specifically a slide that you were showing. We were showing the corporate growth. I mean, the corporate profit growth or earnings growth here. But there was also a very interesting slide where the difference between how strong the economy is versus the way people feel about it was quite a disparity. Now we look back, things are a little bit more calmed down in Iran, although it depends upon what day you're listening to it. But it seems like it's like the markets and people's fears are a little over that, and price of oil's back. But now you look in the rear view and you can really see how strong the earnings growth is.
Yeah, absolutely. And traditionally, when you see earnings grow by this amount, it's coming out of a recession, meaning that the economy had just contracted by a lot. So the earnings are jumping because the economy is starting to grow once again. But we're not in a recessionary environment. And that's the important perspective that I think we all need to keep. So what's contributing there? Well, part of it has to do with the build out of artificial intelligence infrastructure. Not only the growth of the models and the revenue associated with people subscribing to ChatGPT or a similar model, but it's all of the energy and the power and the infrastructure and the data centers that are necessary. There's quite a bit of spending happening, and we'll show you what that looks like. Before we move to that topic, though, people may have noticed when we were going through the market performance that emerging markets did really well in the first half of this year. That's also become an AI trade all of a sudden. And as you're looking at the composition of emerging markets, what we're showing here is that Taiwan, China, and South Korea are the three largest representative countries in the EM index. It was only about 5 years ago that China was 44% of emerging markets. Today, all of a sudden, we see that Taiwan and South Korea have grown in terms of their overall market share because of companies that are producing semiconductor chips. And so that AI trade is also beginning to show up in emerging markets. What I do want to say, though, and just this word of caution for everybody to keep in mind and perspective, is that as we're looking at spending this year, it's estimated that hyperscaler companies, so Oracle, Meta, Microsoft, Alphabet, Amazon, they're called hyperscalers because of how quickly their revenues are growing. In order to grow revenues, they're having to also grow costs, and they're having to spend more money. It's expected that they're going to spend about $800 billion this year, which is just an enormous amount of money, and it's really hard to fathom. But that number will jump to $1 trillion in 2027. So we have to be careful about the idea of how sustainable that's going to be, and where is all of the spending going to lead us? Is it ever going to slow down? At least for right now, it doesn't quite appear to be the case, because we're still relatively early in the build out, or we're getting a little bit further along, but we still have a long ways to go. Now, I do want to talk about just a couple of things we're watching before we wrap up. In terms of what we're watching, well, the good developments as we think about the long term are that there were these institutional foundations from Alexander Hamilton, the Treasury Department, the Federal Reserve, that have been quite supportive to the development of our country for over 250 years. But what we've also been really supportive of, or this idea that is really distinguished the U.S., is that innovation has expanded our opportunity set over time. When you're thinking about the composition of the S&P 500 today, it has a multitude of different sectors and industries. If you had gone and looked at the S&P, quote unquote, the S&P as it would have existed in the 1800s, you would have had one or two primary industries, being railroads, potentially steam engine and ships, or banking. And that was more or less it. So that opportunity set has really expanded out. And what I would also point out is that in early 1800s, about 90% of the workforce was focused in the agricultural sector, so specifically farming. That number today is 2%. And so as you're thinking about job opportunities and how they evolve and labor markets evolve over time, just recognize we've gone through long-term evolutions, and it has still been quite positive in terms of other opportunities available for everyday Americans. Now, the final point I would make in long-term developments is that our investor access has really improved from the things that Hilgard and I were talking about before. ETFs, mutual funds, pooled investment vehicles, costs coming down, and fees being reduced in terms of commissions, and those having gone away over time. Investors are really experiencing a lot of innovation and change. We've always got to be careful that we're doing right by our clients, and that we're working on behalf of our clients. So there are plenty of investment vehicles out there, I would say, to be cautious of and be careful and cognizant. But that's the role that Hilgard and I play in terms of trying to find the right solutions to make available to clients, and not always chase those shiny hot dots as they were. So what's happening in the economy? So that's our long-term picture. Economically, the markets are being supported by a couple of things. One is that corporate earnings resilience we talked about. Labor markets are also doing better. If you go back to September of last year, there was concern that AI was displacing young college graduates. We now see that the unemployment rate for individuals between 20 and 24 has gone down by a pretty noticeable amount, several percentage points, in fact. And it's telling us that young individuals are finding their way into the workforce. AI is not impacting labor the way that we anticipated. What was maybe going on at that point in time? Well, it was tariff policy that was influencing corporate decision-making and CEO behavior. Companies were less inclined to hire until they had better clarity on tariff policy. And that was something that really arrived in the third and fourth quarter of 2025. Consumer spending is also holding up. It's continuing to do okay. So why? Well, part of it is that financial assets are rising in value. Consumers feel a little bit more comfortable spending money. when you see the S&P going up or you see the value of your home potentially appreciating. And we have seen that happen for the last several quarters. AI demand and investment is going to continue to be the thing that drives the market, though, and I don't think that trend is going away for a while. Well, what we didn't talk about was current day Federal Reserve policy. Markets are telling us interest rates will not be going down, and in fact, interest rates are likely going higher because inflation has started to creep back up. So it looked like inflation was getting under control. Now we see that prices of oil have gone back up, and the Fed is going to have to potentially shift path or shift course on interest rate policy. There are opportunities, though, and this is something we can talk about on the portfolio side, is that as energy prices have gone up, we've been talking about things like TIPS and Treasury securities or Treasury inflation-protected securities within client portfolios, talking about other mechanisms for protecting what we call the real yield. And that real yield is designed to grow purchasing power above and beyond the everyday rate of inflation. So that's where TIPS really come in as an important part of our portfolios. The final piece is that geopolitical uncertainty, and we've talked about this for a few quarters, it's there. It's going to persist. We don't see any likelihood that it's going away. Iran and the U.S. don't quite seem to be seeing eye to eye. And Hilgard, as you mentioned, every day we're getting new information and pieces of information. Pay attention to what's happening with commodity prices, specifically around fertilizer, around oil and natural gas, because the more that those prices go up, I think the higher likelihood there's going to be motivation to find a resolution. Now, the final part before we just open for any questions or hand over to you for the team update, Hilgard, is that when we're looking at the economy today, take a look on the left-hand side, because this is one of those other really important and powerful trends that's happened since the 1950s. GDP growth in the U.S. has been very consistent other than one or two environments. And those one or two environments are the global financial crisis and then also COVID when we had the economic closures. Today, we see that per capita GDP in the U.S. is north of $90,000, meaning that per person, our economic output is over $90,000. In the course of the last century, that number has grown by a factor of 8. So in 100 years, we've seen that economic output and growth rise by 8-fold, and that's been very powerful to all of us. Now, real GDP is strong. We've talked about that economic underpinning and where we are. It's AI, it's consumers continuing to spend money. What we could see support the economy from here is growth in housing. So we didn't talk about this, but there was a bill passed in Congress last week that created support and incentives for more home building throughout the U.S. So there's been a question around supply, and is there enough supply to support all the demand? Well, the short answer has been no for a couple of years, but that bill was passed, and it will create some additional incentives. Labor market continues to be strong. We see that unemployment rate at 4.2%. Not a lot of worries within the labor market more broadly. Consumer spending continues to be strong. Nothing really to report there. Where we have to be cautious is around that inflation picture. If inflation continues to grow from 3 to 3.4%, and then if we start pushing 4% again, that's going to raise fears in the bond market. We're going to see interest rates go potentially higher, and that could weigh on stocks as well. A lot of questions left to be answered there. Kevin Warsh, he'll certainly be on top of that, and we'll keep close eyes on the work that he's doing. So overall, we continue to see that the U.S. economy is in a good position. Growth has been resilient. There are mechanisms throughout the economy that are creating this economic support and growth and where we go from here. And what we're going to call this is a no landing backdrop, meaning that the economy is not landing or not falling into recessionary territory. It's not settling into a slow growth territory. We continue to have relatively robust and strong growth, and that pathway forward remains in place. So I'll wrap up there, Hilgard, see if you have any other closing thoughts on the markets and what's happening.
I've got a thought that I want you to expand a little bit about. We've been rolling out to our clients private equity, private debt, private real estate choices and solutions. And as I'm looking at how the stock market is just continuing to grow, I see the disappointing returns inside of bonds, at least year to date. And there was a little bit of conversation about we've, as I visit with every one of our clients, have been really adding on a lot of the private debt, private equity, private real estate funds. And in that area of private debt, there was a little bit of a hiccup, right, with private debt situations. Why don't you talk a little bit about some of the private debt funds we have, the one that was affected, the issue itself? Because I'm just looking at the returns, right, that we are experiencing in private debt funds right now, 8, 9, 10%. Alternative income funds, that we use in our platform compared to bonds, and it's just absolutely, a significant outperformance.
Yeah. So there were a number of headlines early in the year around private credit. It's centered on a couple of articles in particular that people may have read on Substack or other blog posting websites. And the question raised by those articles was, are these effectively fraudulent funds? And is there something that investors are missing? Well, what we've subsequently learned is that the blogs and the posts and the write-ups were put together by individuals that weren't necessarily informed with a lot of details. They were armed with perhaps a bit more emotion and trying to stir the pot, but the actual fundamental arguments that they provided weren't particularly strong. So when we're looking at private credit, we always want to say, what do we think the opportunity is today, more than what was it in the past? So private credit has played a really important instrumental role in portfolios for a long time now. It's allowed for additional return generation, like you mentioned. It's brought unique income streams into portfolios. It has been a strong diversifier without bringing in tremendous amounts of duration or interest rate risk. And that's one of the things that we always want to be careful of. As you add more interest rate risk, and as we're talking about today, if interest rate policy is going to change and rates are going to rise, well, that will hurt portfolios that have a longer duration stance. So we want to make sure that we have an appropriate balance within the fixed income sleeve of core bonds that that are going to be protective and supportive in a risk-off environment, but then also these potentially higher risk-seeking opportunities. Private credit continues to do okay. We're cognizant of the headline risk that's out there. We're navigating through it, but we would just say, at least for right now, we don't see a reason to be overly fearful of what's going on in the private credit universe.
I would probably lobby to say too, when you were looking at the evolutions and the development in the investment world, the concept of an interval fund has made these type of investments significantly more attractive for my mind, specifically because an interval fund, folks, just means that you have exposure to private equity, private real estate, private debt. Sometimes it's a fund of funds approach where you have it all built into one fund. But we have a liquidity feature that we are able to exercise on a quarterly basis, where the traditional private real estate or private equity type of fund solutions with 7, 8, 9, 10-year holds. Now you have a liquid way to go in and go out. Not as liquid as publicly traded securities, but it's a really good complement. And a lot of the studies that has been done on this looks to the combination of that to the portfolio to be a way to reduce risk and potentially increase returns. So to me, that's another evolution of just a good portfolio construction. Chris and his team are very instrumental in helping the LifeWealth Group with our investment portfolios. We have we have a quarterly full investment committee meeting in which we discuss our portfolios and look at any other new niche ideas that we can complement our current platform. And so they are very integrally involved in helping us with due diligence. So Chris, thank you to you and your team. I'm now looking over to the questions for the question and answer session and the chat part. And so let me ask, I go here, Pablo, thank you very much. You asked really good questions here. I'm going to go first over to Jim's question. When you look strategically at investing, how do you balance being at all-time highs and the inevitability of a substantial market pullback? That's a very, very good question, right? Because we are pretty much an all-time buy, and there's a human bias about that too. So good question, Chris. How would you answer that?
Yeah, no, it's an excellent question, the one that we wrestle with every single day. Does a market that's at all-time highs tend to go higher, or do we run the risk that substantial pullback is going to happen? What the research tells us is that it's more likely that an all-time high is going to lead to a new all-time high than it is that market is going to drop 30%, 40%, or 50%. So markets that are expensive, and so with all-time highs, we do have higher valuations as well on price to earnings, price to cash flow, and other metrics. What you need for any sort of change or evolution there is a catalyst, meaning you need a reason for the market to sell off. And at least right now, there's not an obvious reason that tells us, outside geopolitics, which we've talked about a bit, there's not an obvious reason for the market to sell off. When we're talking with individuals and building portfolios and thinking about portfolios, what we're saying right now is that, as we had spoken about on the fixed income side, there's a better opportunity today than there had been 5 years ago and 10 years ago. So what investors should be thinking about is just take a look at your portfolio, talk to your advisor, and determine if you need to take as much risk to meet your financial goals as you may have needed to a decade ago. Hilgert, I know you also incorporate annuities within portfolios. And so there's ways for clients to not have to take as much risk to generate a similar return today as they could have 10 years ago. The opportunity in front of us is to just balance out your portfolio, think about incorporating other investments, potentially bring up the safety assets within the portfolio, and just recognize markets are all-time highs. Let's be prudent about where we're taking our risk.
I love that. We call it like sliding. Let's take some chips off the table is a good idea. Also, just sliding some downside protection underneath already very strong growth oriented investments. Really good opportunities in that regard. If you have a little bit more time, there's some of the downside protection tools that will give downside protection and give unlimited upside. Normally, these comes with capped upsides, but some of them, if you go out maybe like 6 years, where you want to go grow, still some capital, gives you unlimited upside and some downside protection. And a good idea to slide a little bit over to lock in that kind of gain and make sure that it's protected from downside pressure, but not give up any on the upside. Really cool strategies and ideas that come by. One question, Chris, that we get a lot, pretty much every time is government spending. It just seems like the government debt is going up and up and up. And normally when we talk to guys, it's all about ratios and relationships to GDP. We saw earlier with Hamilton that we were up to 40% of GDP, in his days. So just how would you comment about the increasing United States debt, the fact that our government is not really trimming that, and how do they look at that?
Yeah, so we have spoken with Federal Reserve governors about this, so people that sat on the Federal Reserve Board of Governors, and had a conversation with them in the last 12 months on the topic of when does the debt become problematic. And what they shared with us, I thought was really insightful. It's not about the capacity to pay, it's about the willingness. So what that means is that our debt could theoretically be infinite relative to our economic output, and we could continue to pay that debt. Why is it? It's because the US dollar is the reserve currency of the world. Everyone transacts in the US dollar, so we can simply print more currency. What you have to question, though, is how long does that capacity to pay persist? And does Congress ever begin to say, you know what, we've gone too far, we need to reassess, we need to restructure our debt, we need to have some sort of moment where we reimagine the amount of debt that's outstanding. That event is not on the horizon, and it likely won't be for a very long time. Where conversations will start to pick up is around the next election cycle, because, and we're already seeing a few headlines along these lines, the idea that Social Security, the trust fund, is going to, quote unquote, run out of money is going to be a big topic for the next election. So not for the midterms, but once we get to the next presidential election, we're knocking on the door of that trust fund starting to run out of money. And Congress is going to need to look around and say, okay, how do we fund that? Are we going to have to cut back on spending elsewhere from other programs? There's a lot to figure out there. But right now, in theory, the U.S. government could spend into infinite. That doesn't make me feel better. Like making that statement doesn't make me feel better, but at least that was the guidance that was given to us.
Let me ask you about this, because we talked about it at the last quarterly state of the market. Is like we were anticipating some volatility happening through midterm elections. When do you suspect, or when do you start seeing that the news volume goes up, advertising is happening, and more volatility comes into the markets?
Yeah, normally that's between the second and the third quarter, as the election gets to be about 6 months out, then 4 months out. This time we've had other distractions in the form of the war in the Middle East, and the market did sell off in March, so perhaps that was our moment of volatility. We are seeing a little bit of chop here the last couple of weeks, but earnings season is only just now kicking off, so we're going to have bank earnings throughout this week, and then we'll begin to see the technology companies and others within the S&P 500. That'll be our catalyzing moment for markets to either move higher or lower. One thing that we didn't talk about is expectations are quite high for earnings growth. So as much as companies have really delivered on them the last 5 and 6 quarters, expectations are now high, and that could lead to at least a bit of disappointment going forward. But companies are still suggesting and giving us a lot of very positive guidance, other than what IBM came to market with yesterday. So there are a few situations where companies are saying, yeah, things aren't quite as good as we expect, but overall it's been okay. So perhaps we start to see a little more volatility around earnings, and then that could carry forward through August, where August is notoriously a challenging month at times, only because liquidity is very light, as so many people head out to the beach and go on vacation, and they're not as focused on the stock market.
I'm going to have time for one more question. So, obviously what we hear, it seems like what we hear about the negotiations with Iran and what really is happening is the big question mark, right? So what is actually, how much do we really hear about what's really happening? So if the turmoil were to reignite in Iran and settlements is not followed through, what do you feel like the impact would be to oil as well as maybe the markets?
Yeah, that's the question of the day, and it's a very tough one to predict. What we hadn't spoken about today, which has been supportive of getting us through this environment of higher prices, is the tax refund cycle that we talked about in the first quarter. Tax refunds were higher in March, April, and into May. And that provided households in the U.S. a couple $1,000s of additional income or money in their bank accounts. That really offset the cost of houses, both for filling up the gas tank as you go on vacation this summer, or thinking about higher prices when you go to the grocery store. We are seeing evidence that the tax refunds are starting to wane, though, and people have effectively chipped away from the entirety of the refunds that were given. So the shot clock is running, but I would say don't forget the midterms are coming. So there's a motivation to keep prices from going dramatically higher. The U.S. government has also been releasing oil from the Strategic Petroleum Reserve pretty frequently in the last several months to try and put an upper bound or an upper cap on oil and energy prices. And that's one of the reasons we don't see oil north of $100 right now per barrel. If anything, we've seen it quite a bit lower than I think people would have assumed. The shot clock is running, that proverbial shot clock, and time is very quickly running out. I would have to think that as we get into the fall, if the conflict is still continuing, oil prices are going to begin to move pretty quickly higher, which is going to cause interest rates to go up, which is going to cause the Federal Reserve to have to tighten monetary policy as well. So I would say between these next 45 days in July and August, that's our window. If we come back in September and there's no resolution, I'm not sure markets are going to be so happy.
Well, your comments has been fantastic today, Chris. Thank you so much. A very wide communication around all different kinds of topics. Thank you for making us feel patriotic about America. What a 250 years.
I promise we won't do that every single quarter. That was the one time we had this 250th anniversary. It was hard to resist.
Absolutely. Well, folks, I thank you very much for your attendance. We normally try to keep it to 45 minutes. Just a few final comments on our side. Our team is continuing to grow. This is our year in which we're building our bench very deep with planners as well as a service advisor. You all know that Joe Continelli so sadly had to transition due to his health, and it's taken us some time to really select a great replacement for him. We found Frank St. Armand up north, actually Massachusetts, and great fit for the practice. He joined us about 2 weeks ago. We had our client advisory board. So while I have some of you on here, we talked a little bit about just how can we improve and get great feedback from our advisory board members. The topic of growth came up, and one person said, well, listen, Hilgard, when you grow, doesn't mean it's good things for us. It means maybe the service and the quality of service will water down. And we thought it's the opposite. With growth comes the ability to have access to more investment platforms as well as a deeper bench. But I was explaining to our client advisory board that before we put any advisor in front of any of our families, they will really go through 6 months with a very rigorous training on our side in order to be able to make sure that we are comfortable that they can visit them with families. So our heartbeat is to expand our impact to families that we are able to serve. We are about close to 550 families at this point in time, but we are building a very deep bench, and it takes about 6 months. So Frank will be 6 months in training in our planning department before he steps out to bring additional power on the service side to our clients and our families. Tonight, I have another interview with a sales advisor, so hopefully we'll be adding him as well, with the same type of structure of at least 5 to 6 months of the training in our planning department. We've added Steve and Austin in our planning department, two very sharp individuals with industry experience. We're enjoying our culture in a big way and enjoying making a big impact. Steve is in my team with Lewis, so myself, Lewis, and Steve are serving about 150 families, and then Hilton and Josiah serves the rest of our families. Austin is part of Hilton's team. So things are growing very, very well. We got a lot of great excitement. We've inducted 2 new members to our Ambassadors Club. This is where we thank you very much for introducing us to other friends and family members. 2 very cool events this year coming up where we are celebrating our folks who have introduced us to either 1 or 2 couples. Ambassadors and Lead or Ambassadors Club. We got those events already scheduled and great celebrations. So I want to thank you for those of you who introduced us to families. Thank you so much and welcome to the Ambassadors Club. We're excited to bring this back for our practice. We've got upcoming workshops. We've moved our location from Market to Table here downtown Winter Garden to Bella Collina, our country club. Looks like beautiful Tuscany out there. We're actually having a very cool venue. It's in the wine cellar. Great opportunity to come and listen and hear from Hilton and myself. We are predominantly presenting, sharing concepts around how we come alongside families. If you're kind enough to bring a family with us, you'll be at a special table with your own unique bottle of wine that we would celebrate you. And I would just say thank you for those who have introduced others to us through this format. You certainly warm up the room in a big way for us. It's always fantastic to see our existing clients come and join us at these events. If there's anybody that comes to mind that you would love to invite, please feel free to take a look at these dates, let the team know, and we'll reserve your spot with any of your friends to come and join us for that. Then we're doing our learning center is busy. We're doing a lot of very cool events. We introduced a new event called the Breakfast Club. So one of our client advisory board members mentioned and says, hey, you do a lot of events at night. Can you do some at lunch? Can you do some at breakfast? The Breakfast Club was an absolute winner. It's over breakfast, and we had a great specialist in the Medicare supplement area that is part of Advisors Excel that is available for any of you who needs or want to look at Medicare supplements or Advantage plans. Fantastic expert resource, and we had our first Breakfast Club. So we're going to talk a little bit more about risks coming up in August 21 to retirement, the big what-if questions, if there's still things that is of concern to you. This is a great event to come and listen to how we combat that through planning and strategic portfolio designs, working with Chris and his team. We're starting to invest in the next generation. Josiah and myself are rolling out this wonderful workshop where we're talking to your children and your grandchildren, and please feel free to invite them. This is financial literacy to the second generation and third generation that could be very, very helpful for any grandma, grandfather, or mom and dad that wants to communicate financial principles. Very, very good to do that. Makes perfectly sense, fits very much in your estate design mindset and your impact and legacy as well. So I wanted to thank you guys so much again. This is next time that you'll see Chris and myself here on this webinar will be in October. We'll be excited to share with you about midterm elections. Chris, is probably going to be a big topic for us as we discuss volatility in markets and where are we at that time. But the U.S. economy is roaring. It looks that way very much. It's been doing that. We can see the trend. It's a good time for your capital to continue to grow. Let's have conversations about taking some chips off the table if we need to really benefit from a very nice run-up year from the beginning of the year's last 2 years as well. So thank you very much, Chris. Appreciate you very much. Have safe travels back to Virginia. And thank you, family, for joining us. Look forward to being with you next time.